use of two issues. One,
so, ladies and gentlemen, I hope you had a nice lunch, and we started our morning session by trying to understand what needs to happen, what is the scale of the challenge, and how to meter it, and talked about the sustainable finance also. Now in the afternoon, we are moving forward with more detail and understanding what is the role of the financial sector, what they can do, and what role the reporting, the other proposals that are proposed by the Commission are going to play here, and then, of course, how to make the financial sector sustainable, sort of looking forward, what are the next steps needed and required and proposed, hoped from our audience and from the business community. And it's my great privilege to have our keynote speaker today here from Real Expertise, Mr. Anders Uterman. You are Chief Executive Officer of Allianz Global Investors and a member of Globe EUB Group, and you have a quite extensive history in investments and in sustainable investments, so you know how to do it and what kind of challenges you are facing there. So we are very much looking forward on your keynote. What would be your message to us and for the business and administrative community? Please, the floor is yours.
Yes, thank you. Me too. Thank you very much, Sirpa, for these very kind introductory comments, in particular for highlighting my experience and not describing me as I'm often now described as a veteran of the financial services industry. It's a great pleasure to be here today. Actually, it's sort of, in many ways, it's a return to my roots. My parents both worked for European institutions. I was born and raised here in the city, and I never imagined when I grew up here and went to the European school that I would be addressing an audience like this, parliamentary style, first one for me as well. And yeah, it gives me the goosebumps. I know the important work you're doing, and hopefully my small contribution this afternoon, as well as the panels today, will continue to help to enlighten the debate around this incredibly important topic. You've rather grandly titled this a keynote address. 10 minutes, I don't think that quite qualifies, but I will try to hit a few key notes. So I've structured my introductory comments to this next panel in four parts. Firstly, brief overview where we are. Secondly, talk a little bit about what the role, in my perception, is of capital market participants, the buy-side firms, and so on. Then talk about what we actually do, where we stand, and then finally how potentially the public sector can help bring this topic, speed it up and bring it forward some more. So I think starting with perhaps the Paris Agreement, why not? That was signed in 2015. Is certainly a milestone for the world and the global economy, in our view. One by one, nations have taken the necessary steps to put the economy on a more sustainable and resource-efficient footing. The announcement of the new EU sustainable finance legislation proposal has already had a strong signal in effect on ESG. More on that later. ESG is really getting serious attention from across the investment industry, including players that potentially in our industry weren't keen on this topic at all, but I think it's something that's now become pretty much inevitable. And, maybe perhaps not surprising, given also the way that client demand has evolved over recent years, the EU is indeed leading in this shift. That there's a long way to go. Reforms along the entire investment chain, I think, will be required, not only to fill the significant gap between the amount of capital required to finance the transition to a low-carbon, climate-resilient economy and the amount being invested, but also to build a sustainable finance strategy for the EU. Mobilizing private capital, i.e. the capital that our investors entrust us with, to fund sustainable investment is essential, as the scale of the task ahead is certainly, in my view, well beyond the capacity of the public sector to lift a shift alone. So for these reasons, we clearly welcome the invitation the European Commission has extended to the financial sector to take active part in these discussions that we hope will lead to a greener, cleaner and more sustainable economy. Allianz GI is very proud to be one of the 30 members of the EU Sustainable Finance Expert Group, and we're profoundly committed to fostering an ESG-minded approach to investing across the European Union, and I would say actually globally as well, because I think it won't be just restricted to the European Union. This will quickly become a global set of standards. We see this indeed, and I'll come back to that in a moment, as a collaborative process where we are working with policymakers, our clients very importantly, and our investment teams to achieve a shared goal. So as an example where we stand at Allianz GI, we're in the process of integrating ESG across all portfolios, whatever the origins of the strategy. So far, about 124 billion euros have been converted to integrated ESG, which represents around 20% of our assets, and that goes without saying. It's obviously with the consent of our client base. Many firms talk about integrating ESG. We have built evidence that ESG can add value to our investment process through a combination of robust research of financially material ESG and factors and company engagement without constraining our investment universe. And that's really quite important, because I think without the proof points, it's just labeling, and we know what that is. That's really not real. To Allianz GI, and this is also very important to stress, we're an active firm. Our integrated ESG approach represents really the next step in the evolution of our investment offering. This is not something that is a fad. This is something that will fundamentally alter the way we do things. At the same time, and this is another important point to note, we have a very large client base, and many of them would like to invest in a socially responsible way, following, for example, many clients here in Europe, best-in-class SRI methodologies. We have growing interest also from institutional retail clients in what we call so-called impact strategies, whereby a specific, clearly defined, identified environmental or social impact is expected alongside competitive financial returns. So we really have these two areas. We've got the restricted universe specifically targeting particular outcomes, and then we've got our integrated approach, which we think will apply and adopt across all our strategies. So what's the role then of financial market participants? To come to my second part of the overview, I think I'd like to quote Paul Smith here, who is the President and Chief Executive Officer of the CFA Institute. I quote, "The next generation of investors, and a growing number in this generation, will not accept the absence of precise quantitative frameworks as an excuse for inactivity. They are demanding that the investment industry responds to their desire to proactively address some of society's most intractable problems." Now, clearly achieving this will take vision, ongoing honest engagement with policymakers and regulators, and we've already been doing that by hosting dinners with MEPs, for example, or having similar discussions in the ICI in the United States. Educating financial market participants, I think it's one of my biggest bugbears. I think financial literacy is very poor. So we need to address that. It's not directly related to ESG, but it's incredibly important, because if people don't understand what we're talking about, it won't have the desired impact on the demand side. And of course, inevitably, and this is something that we've had to adapt to and accept, is obviously comes at additional cost. Our ability to do this, to be present at AGMs and so on, is obviously expensive. It's part of the reason why it hasn't happened to the extent required in the past. I think it's now happening, and we've budgeted for this, as many other buy-side firms have as well. So the mindset of the financial services industry, the prevailing culture, and the incentives will also need to align with the longer-term nature of ESG investing. Our greatest challenge today is to be able to operate as a long-term responsible investor within, alas, a system that is largely set up to deliver short-term returns. And that's a real dichotomy. And I think this is where policymakers and regulators can play a major role in creating an environment where all the links in the investment value chain are able and incentivized to adopt a longer-term perspective and somehow reconcile the long and the short term, which is a really big challenge. And hopefully maybe you can discuss that in the panel as well. As an investment industry, we obviously have significant fiduciary duty to do whatever we can to protect and enhance the value of our clients' assets. This includes carefully selecting investments, engaging with issuers to reduce investment risks and improve corporate practices, but also working with policymakers to address key sustainability challenges within our capital markets and the broader economy, and this is where these dialogues clearly come in. Now, there's clearly a role for policy and regulation in achieving the necessary focus on long-term sustainability, as I've just stated. However, a truly enabling regulation, in our view, should be principles-based, creating a clear framework of definitions, expectations, and disclosure requirements, very important point, that one, which by institutional and retail investors. We think a prescriptive approach that restricts investors' ability to align their investment objectives with their sustainability goals, whichever the objectives might be, is unlikely to generate the required flows of capital into ESG strategies and actually could potentially currently reverse the positive momentum that we're seeing. So let me then move to the third part, which is what can we do concretely, what are we doing concretely today? So historically, environmental and social costs or benefits of business activities were not incorporated into investment analysis. And the reason was simple. They didn't affect a company's reported profitability. And this means that corporate cost of capital has not been reflective of long-term sustainability of equity and bond issuers, creating a disincentive for investing into sustainable business practices. However, the world, as we know, has changed, and so-called extra financial factors, or as we used to call them at uni, externalities, increasingly impact the financial value of companies we invest in. And investors are changing as well. We clearly see that with our clients, with the incoming generation, the millennials and the younger, showing much more interest. All the surveys show that in aligning their values with their investments and indeed consumer choices, and that would tend to also suggest that impact funds and SRI strategies will become very popular indeed. So this means that for us, adding an ESG lens to traditional investment analysis can lead to improved investment decisions, as well as contributing towards creating a more stable, sustainable market and society with more desirable investment products. So the scale of today's social and environmental challenges, with heightened political uncertainty, widespread inequality, and significant pressures on the environment, makes it evident that the responsibility to address them does not fall on policymakers and regulators alone. Businesses and investors must embrace their responsibility to push for progress, and I think we're doing that. So investing in sustainable way should not be limited to dedicated and labeled ESG investment products. It should become standard practice. And that's what we're arguing for publicly. That's what we're telling our clients, and I think more and more firms are actually following us. And we're doing that because we indeed think that this will result in enhanced longer-term returns, not just reduction in risk, and will also benefit societal and financial returns for all parties involved. So this is the cornerstone of our investment philosophy and the reason why at Allianz GI we're integrating ESG and applying stewardship principles across all our strategies and assets, while also offering more tailored investment solutions for clients with specific sustainability objectives. Now there is, of course, and this is again where we need some help, a strong and ongoing need to enhance the quality of ESG disclosures and data by issuers. Relevance, materiality, and comparability of ESG disclosures, as well as insights into environmental and social impact arising from their economic activities, will be key to building a common language between investors and issuers. We are confident that under pressure from policymakers and investors, these will improve going forward. And indeed, again, we're having lots of discussions, such as, for example, at the IFRC, suggesting that some of the reporting standards should be adapted to precisely deliver some of these outputs. So let me come to the final part then and look a little bit about what we're looking for from the public sector. So I've just talked about the financial sector and this big role it can play and does indeed play. I think policymakers must carry out a very important path in ensuring that negative environmental and social externalities are appropriately priced and translate into operating costs for those directly responsible. I mean, that's critical. We can't affect that. We can invest in companies. We can't tell them to pay taxes voluntarily for externalities that they produce. Policymakers need to do that. It's not happening. If you ask me, this is one of the absolute top 1 or 2 ways that progress can be turbo and supercharged, because that's really what's going to have a very big impact. So tax the externalities, it'll have a massive impact. For example, the absence of a carbon pricing policy that reflects the real cost of CO2 emissions, it goes to that point. And, it's very interesting. Society isn't clear about this at the moment. I was just in Paris yesterday. They have the yellow jacket protests. So on the one hand, they're protesting because fuel prices are too high, because they're being taxed. On the other hand, they're going out the next day to try to protest in favor of protecting the environment. Something needs to change in the debate here. So as experts in our field, we have the privilege and duty to help policymakers and regulators to develop the vision, rules and guidelines that will shape the future of the industry. We also have the responsibility to speak up if we identify potential unintended consequences of any proposed legislation to ensure these are addressed. So what are we looking to? Well, we'd like to see a framework that allows a variety of approaches, but lays out clear and robust expectations and requirements for those offering sustainable investment products. I think that will help minimize the incentives for greenwashing, again, by requiring transparency and alignment between stated sustainability objectives, investment processes, and measurement and reporting of sustainability performance. I think we need a framework that places value on responsible ownership or active stewardship practices. They don't come for cheap. I mentioned this earlier. And I think we also need some help with the framework to address the conflicts of interest in the investment value chain that I alluded to earlier. So to conclude, to be clear, investors already have incentives to integrate sustainability considerations in their investment processes. Otherwise, we wouldn't do it. For us, it's clients. For us, it's enhanced returns and reduced risks, and obviously our shared and joint common concern for the environment. Furthermore, I'm convinced that ESG integration will become a must for investors and that laggards will become unfit for purpose. I talked about it earlier. Without this, you will simply not have a license to operate. I don't think sooner or later feels urgent enough, though, given what's at stake. Therefore, I think, and this is again coming back to what I said right at the end, developing a robust, non-prescriptive, enabling regulation would accelerate the process significantly, including the tax framework. This would be an unalloyed good and an endeavor we and other like-minded investors would be happy to work with you on. Thank you very much again for asking me to be here today.
And thank you for your commitment for sustainable investment and your contribution. It remains to be seen in our panels how do we then avoid the distortive impact in taxonomy or frameworks of member states' interest to have clean coals or sustainable bioenergy or whatever that happens to be in national context that might not work for the greater good. So that is one thing, how do we balance with that. But with these words, once again, thank you. And without further delay, Nena Gill, you are where? Yes, I'm just looking the Nena to come to chair the panel, but she'll join in a minute, so we'll make an invisible change here. And we'll move up on the next session about reporting and disclosure. How do we provide better information for the investors? And Nena has been active participator in this sustainable finance debate and rapporteur about the benchmark at the moment. But before we move up on that panel, as agreed, Stanislas Dupré, could you please join us and have your intervention now as a first intervention about this session, because we needed to abruptly cut you out of the second panel before the lunch. So absolutely. Thank you, and please feel free. The floor is yours.
Thank you, Sirpa, and thanks to GlobeEU for the invitation, and sorry for the next chair of the panel to crash your panel. So as you mentioned, Sirpa, I was in this building 7 years ago to pitch the idea of integrating sustainable finance into financial regulation. Since then, the topic made its way to the policy agenda, and my organization has developed climate scenario analysis for the finance sector that has been integrated into the first laws on climate-related financial disclosures in France and California. and we turned this into a free tool that is now used by leading financial institutions and supervisors. So actually, that would have been a good topic for this panel, but I will talk about a second topic, which is the one of the first panel. So first, I want to say that as a member of the HLEG, I was very supportive of the action plan of the Commission, and I'm still very proud of the work of the group, and clearly think that Europe is leading the regulatory debate globally on this topic. However, I will take the opportunity of this event to share a concern I have related to the topic of the previous panel. You see here on the screen the definition of sustainable investment in the regulatory package that have been introduced and is currently discussed. I think this definition works very well when applied to capital expenditures in the real economy, so real investment. But pardon my French, I think it is flawed when applied to investment in securities and financial products, which is a core purpose of part of the regulatory package. I will explain briefly why I think there's a problem. So one of the main goals of the action plan is to help redirect investment flows from brown to green economic activities in order to reduce the carbon emissions in the real economy. And I stress this aspect, in the real economy. One way to facilitate this shift as an investor is called impact investing, helping economic players who want to make this green investment but faced a financing gap. This concept can be applied to villagers in Kenya who want to power their house with solar panels. It can also be applied to clean tech entrepreneurs in the Silicon Valley. And the more you provide finance, the more projects you make possible in this space. Even though, given the cost associated with due diligence and finding projects, scaling up is painful in this space. So I would say no pain, no gain in this space of impact investing. For impact investing to work, the financing gap must be the main obstacle. In other words, the limited financial flows that you use as an indicator should be the cause of the problem, not the consequence. And so I will give you a couple of basic examples to illustrate that. As an investor, if you provide more finance to Iceland, that is already 100% renewable, you won't boost their investment in wind farms. Seems obvious, but that's an example. The same applies to the French railroads. Buying their bonds won't multiply the number of trains because the investment of the companies are limited by a cap on their total debt in order to maintain the credit rating of the company, not by a shortage of investors who are ready to invest in their sovereign bonds. So if you want to identify activities that should be prioritized for green investment and financing, which is one of the main purposes of the taxonomy, it's not enough to consider how green they are. You should also consider to what extent more financing actually is a trigger for more investment. And that's not necessarily the same case for all types of investment. I think ignoring this dimension is one of the first problems we see in the definition that is in the current draft of the regulation. And if it's not taken into account, the regulation will de facto incentivize a move toward green investment grade things, like the bonds of Iceland or my French railroad company. So we might end up with a zero-sum game. And that's one of my first worry on this topic. I see a second concern, which is that most investors, especially institutional investors, For them, investing means buying securities from other investors. They operate primarily on secondary market. The decision to invest in green and brown activities in this context is not made by investors. It is made by the management of investee companies. And most investments are actually financed not by like more equity, but by reinvested profits. In this context, if investors want to influence investment plans in the real economy, the investment plans of the investee company, their main lever is their voting power. That's why you see coalitions of investors like Climate Action 100+, prioritizing this lever and this way to act. However, in the regulatory package definition as it is today, the contribution of a financial product is exclusively based and defined by its exposure to green economic activities, which completely ignores the use of voting rights and more broadly the influence on investee companies to shift their investment. So I might sound a bit nerdy and picky on definitions, and it looks like a detail, but I think, unfortunately, these issues have already very concrete consequences. The first sustainable finance regulatory package have like flagship instruments that are green bonds and low carbon indices. And I think in both cases, they score pretty high on popularity, primarily because they are associated with no pain for investors. They have the same credit ratings for green bonds, a low tracking error for low carbon investment funds based on these indices. But I think no pain for investors means no gain for the environment. Like in the example of Iceland or French trains, investing in these vehicles is likely to be a zero-sum game at the end of the day. So you usually have, like, I would say, nice narratives on how they might eventually contribute to cut carbon emissions in the real economy. But when you have a closer look on these stories, and we did, it looks a little bit more like fairy tales rather than hard evidence. So that's a pretty pessimistic view, but I think the good news is that the regulation is still a draft, debated by the Parliament, the Council, and this definition can be changed. I think it is still time to define what sustainable investments means when specifically applied to investment and financial products. Just an article to add in the regulation. And to draft this, I will suggest to base it on the following test. As an investor, do you influence the decision made in the real economy, or do you just change the exposure of your portfolio? That's the first question. And if you try to influence the decisions, how efficient is your approach? Does it actually work? And do you have evidence that it works, or only a nice story to tell about it? So that would be my suggestion for the next week of work of many of you in this room. Thank you.
Thank you. I'm sorry, because we're running so late, we're going to have to go straight on to the next panel. Otherwise, I'm going to be on a flight. Absolutely. And the panel will still continue. Okay, thank you.
More trouble.
So maybe later on you can get an opportunity. Could I now invite everybody participating in the third panel, and that is Nathan, Gianluca, Rianne, and Paul. Paul, and then Rianne. Thank you. Paul. So thank you very much for joining me for this session. And this is to look at how we strengthen disclosure of sustainability indicators by companies, and we'll consider development of harmonized integrated reporting framework and international accounting standards for sustainability metrics. And we're going to look at the sort of balance between harmonization and flexibility of different frameworks and the role that the company boards can play. So just as a way of introduction, I know Sirpa has already introduced me, but I would like to first thank her for the initiative and for Globe for organizing this event. I popped in this morning and I saw that we had some really good, positive discussions and made it very, very clear that why we need a transition towards sustainability and how best to define sustainable finance. Of course, to achieve these standards, the key players need to be convinced institutionally and convince the institutional investors and the retail investors. And I, as somebody who is the rapporteur on sustainable finance benchmarks, I think it is absolutely clear for me that investors must understand the language and exactly what they're getting behind different labels. And so I think we've seen a lot of evidence of greenwashing in the past, and what we're trying to do is to avoid this and to try and ensure we have a gradual transition. And I think we have a lot of debates within my Economic and Monetary Affairs Committee, and in fact we had a debate yesterday as to what is the ideal situation and what is the reality and how do we achieve this. But my colleague Paul Tang's report, which got strong support, clear message that financial sector disclosure of sustainability risk has to be higher up in the agenda, because clearly there are a huge number of risks out there. And so I really don't want to say much more, and perhaps we can expand on it in Q&A, but I want to take this opportunity to introduce the panel. And excuse me if sorry? I'm Nathan. Oh, you're Nathan, okay. So I was not going to give detailed introduction. I think the CVs have been circulated, so most people can see. But I am delighted to invite Nathan Fabian, who's Director of Policy and Research with Principal Responsibility for Investment. So the floor is yours.
Thank you. Thank you, everyone. It's a pleasure to be here. I do work for the Principles for Responsible Investment, and I'm currently the Taxonomy Technical Expert Group Rapporteur. So my comments will tend towards the usefulness of that tool, which we hope will be the case. PRI is in the how-to business. So we would welcome the ambition and direction of our MEPs on sustainable finance disclosures. But being in the how-to business, I'll try and set out a couple of ideas that we need to resolve if we're going to clarify how additional impact metrics and additional impact indicators are to be brought into the market in this phase. So broadly, we see that there are two types of indicators. We can think about the impact of a company on the environment or on society, and we can think about the impact of the economy or of the environment or society on the company. And so the latter has traditionally been in the risk approach, and the whole ESG world has focused primarily in the past on assessing risk. So is there a chance that an environmental or social issue will impact the company and perhaps the financial returns to the investor? I think the essence of the energy behind our MEPs is how do we think about the impact of the company and the investor on the environment and on society? I think that's what we mean by impact, but it's important to have that one clear in our minds because it takes us down different pathways. TCFD is primarily in the what's the impact of climate on the company and on the investor. So that one is critical, but I'm going to park that for a moment. So focusing on the first, it's important to think if investors are asking companies for data, we need to think about how investors can actually influence the flows of capital and the way that corporations act. And we see broadly there are three ways. You can allocate capital as an investor. I choose an investment with a positive impact or not. I can be an active owner, as Stan nicely presented with his chart. So I can encourage a company I own to do something better, and I can support an enabling environment, so policies and institutions and market frameworks. So they're the three main tools I have at my disposal as an investor. And so then we need to ask, okay, what type of information would support me to perform the fullest role I can in getting a positive impact on environment and society? And so across all of those, well, across especially the first two, the allocate capital and active ownership, there are really two things I can do broadly. I can seek out purpose-driven companies. So a company whose mission it is to have a positive impact. There are some investors who seek those out whether there's likely to be a financial return or not, but most of the capital wants a financial return. Capital market wants a financial return, which is understandable. Or you might target companies for whom some of their activities have a positive impact. And then you might encourage that company to develop over time to have a more impact. But ultimately, investors give capital to companies. That's what we do in different forms. Listed markets, private markets, infrastructure, clean tech, whatever it is. Ultimately, there's somebody else doing something with the money. Okay, so they're the ways we can act. Now, it's important to think, if they're the ways we can act, what type of information would help us perform our roles, to choose those positive impact companies and to choose those companies that we want to encourage to perform more positive activities. And this is where I think the relevance of the taxonomy is very high. The taxonomy, by identifying economic activities that contribute to environmental objectives, have the potential to allow the investment chain to identify revenues, company revenues, that flow from environmentally sustainable activities. This is a key part of the narrative for a company, obviously their data, but for an investor to understand, can I allocate more capital to those kinds of activities? Do I have to find purpose-driven companies to do it? Can I find companies that have some business in that area, and can we increase it? So the taxonomy gives us potential to have disclosures with green revenues or environmentally sustainable revenues, and in time, as we take on social issues in taxonomy, socially oriented revenues. So there's a disclosure approach that enhances an investor's ability to have impact. So we should be exploring that as a discrete opportunity. The other opportunity, which I think is a bit more difficult in the market, is understanding companies' capital expenditure plans. If you can work out that a company is investing its capital in future sustainable activities, either environmentally or socially, you've got an understanding of where future revenues can come from. Now, companies don't always want to disclose their future CapEx plans, okay, let's face it. But this is an area to explore because it's a signal about the future economy and the future revenue exposure. And then the other area, which Paul will talk about, I'm sure, is narrative, an integrated narrative about the future, so that you can understand a company's strategy, its approach to how it's thinking it's transforming itself. Now, that green or environmental revenue data is a very concrete way to have a conversation with a company about its future plan. And so we must remember that, contrary to Stan's intervention of a moment ago, the taxonomy is going to be one of the main enablers of active ownership. These are not in contradiction, they're actually perfectly aligned. And so we can achieve more active ownership with better data and potentially some CapEx information on sustainable activities. Thank you.
Thank you very much, Nathan, and for keeping to your time.
My pleasure.
Can I now invite Gianluca Manca, who's Head of Sustainability with Eurozone Capital.
Good afternoon. Thank you very much for the invitation. I also wear another hat today. I am also proud and honored to say that I serve as chair of the metrics, indices, and benchmarks working group at the European Banking Federation. So I like also to bring, besides the capital market, which I belong to for 20 years, I like to bring also the experience of the credit institutions of Europe with what's happening now in the EU Commission and in the Parliament. In 20 years, if there's one thing that I learned is that when we talk about disclosure, we're talking, I believe, in a two-way process. On the one side, there's the capital markets guy like me, asset managers, who go to questioning companies we invest in, asking them for concrete information we can serenely put down our numbers and say, this guy is worth it, that target price is okay. On the one side, in doing so, we encourage company to disclose the data we are interested in. And now it's a very fashionable moment to go asking about carbon footprint, for instance. So how does disclosure improve? I went through, of course, the action plan. I went through Paul Tang's amendment, and I went through, of course, the latest piece of compromise. And I find myself very comfortable with that. I can say also at the European Banking Federation there are no major issues on that paper, which is a great success because it says that a lot of people around the table agree with its content. And what I like best in terms of disclosure in that particular piece is that it gives everyone a way to make the metrics functional. Because up to date, if there's one thing that we missed is data and education. Take, for instance, an asset manager. An asset manager that wants to invest in a very responsible way, he has 3 or 4 or 5 at the maximum private houses that produce data on sustainability issues. But this data is provided by a number of people that is not sufficiently high. Because in total, each of the provider has 100, 130, 150 at the most analysts, and they must cover more than 5,000 up to 10,000 stocks. So how do we gather the important information? Well, if you look at the recent history of scandals occurred in the stock market for environmental reasons or governance reasons or social reasons, you go back to, for instance, BP, the former British Petroleum, and the Deepwater Horizon case, when the plant exploded. And the facts that came out of that event were huge. 50 billion spent just to replace the damages this company has made. The stock price of the stock went down severely. And you can imagine somebody who had the pension expressed in UK and had it in UK would mean that they had only FTSE as equity exposure. In the FTSE, BP would weigh 8%. So I would imagine someone who had been spending 35 years of contribution to a pension fund, all of a sudden he sees a 4% blowing off. But the thing that I want to tell you now is that BP could have been prevented not with sustainability data, but with normal data. Just maintenance, CapEx/sales. We could have compared all the operators in the market and we could have just seen that they didn't spend enough in maintenance. Would you ever take a car for a long run without it being maintained? Nobody would. So it's a normal data. It's a traditional data that could have been used for the BP case. Toshiba, same story, 2015, huge, the biggest scandal of accounting in Japan. 1.9 billion of fraud in 7 years. Was that detectable in advance? Of course it was. We needed performance indicators. We didn't need science that goes beyond magic. We needed to have a list of things we needed to ask to these companies. We didn't do it. So what I like very much of the compromise is it puts down in good order the things that all the analysts, all the risk managers need to have in order to address what their problems might possibly be in a company. Volkswagen, that's another case. There's the recent case of scandal, it was Facebook. And in Facebook, we all know what they do. They collect data. So we all know also that in 1948, there was a Declaration of Human Rights. Article 12 said privacy is one of the human rights. So what does Facebook do? They need to protect the privacy of what they do. We don't care as fund managers and as people, as citizens, if they change the light bulbs. We don't care if their CO2 footprint is different than what we would like to have. What we care is the core business, that what they do, collect sensitive data of people. They need to take care of those, and so on and so forth. So again, what I like of the compromise is the detailing it goes through and that gives that also the range of tolerance across time for all the financial and economy sector to adapt to it. But we can talk about this later as well. Thanks.
Thank you very much. And again, being so succinct. Thank you for that. Right. I now invite Paul. Paul Druckmann is ambassador to the Prince's Accounting for Sustainability project. The floor is yours.
Thank you very much. It's quite interesting sitting here with the Accounting for Sustainability hat on, as was described before. Some of you may have heard me speaking about integrated reporting mainly in the past. But there's a great thing about being an ambassador in their terms is firstly, and most importantly, you're unpaid. Secondly, the assumption is that you have time. Third, that you're old. And lastly, that you were involved at some stage. So I tick all of those boxes because I helped create Accounting for Sustainability back in 2004. So I'm going to start with the Accounting for Sustainability and then in the panel session talk about some of the other areas that I'm interested in. Now, I'm an accountant. I've got 5 minutes, or probably 4.5 now, and I've got 9 things to say. So it's going to be quick, okay? So, firstly, 5 key messages. So, first thing is that mandating climate-related financial disclosures is a when, not an if. We need to do it. Let's not mess around. Let's get on with it. And I think there are various ways that can be done. And I know that we'll talk about that later. Number 2, we need, in my opinion, more practical examples, more case studies about how to demonstrate how businesses actually take these things into account, to demonstrate the business case. And in fact, A4S, and I'm sure others, are gathering examples together and hopefully disseminating them through websites and other things. These business case studies, these need to be understood. The third key message for you is around scenario analysis. Coming from a business angle rather than an investor angle, we have to demystify, when we come to thinking about sustainability, the whole area of scenario analysis. And I'll pick that point up slightly later as well. My fourth point is around pressure from investors, which is what a lot of the discussion has been about. But we do need to make sure that we map each actor's role. We talk about investors. Investors is not one homogeneous group. They don't all think the same, and they all have different parts of the investor landscape. The new stewardship code in the UK, which will be coming out next year, actually breaks investors down into 4 component parts: asset owners, asset managers, investment consultants, and proxy agents. And we do need to understand that there are different rules that need to come into place and different governance regimes that they all need to understand. We do need to make sure that the information that is disclosed by companies is decision useful. And I know that Rihanna will pick that up. And that it's holistically used by investors. My fifth and last main point is, again, going back to companies, is around boards. And we need an engaged board. And actually, one of the biggest failings of the engaged board is not that they don't want to, but they lack knowledge. We need to give them the confidence of educating company boards so that they know what they're talking about. It's amazing how many of them would agree with much of what we're saying, but don't put it into practice because they really don't feel that they are experts and they know enough. We need to make sure that's changed. So those are the key messages. If I move to the reporting side of things, there are certain things that I think need to happen. Again, trying to be quite succinct. We need to accelerate the adoption of the Task Force on Climate Financial Disclosures framework. Right? I know there are issues about what happens when and how, but let's make sure that that happens. We need to make sure that we integrate sustainability information, using the concepts that we developed at the Integrated Reporting Council, but nonetheless those concepts are now generally accepted in both the investor world and the company world in capital markets. And the other thing is we need an international global body to set sustainability standards. Okay, now the corporate reporting dialogue is something that's just had a significant amount of funding from Bloomberg to do some of this work. Also, one of my ideas that we might explore later is the IFRS trustees might have not just the International Accounting Standards Board, but maybe they have a sustainability board and other areas to cover. And then lastly, we do need to think about how the SDGs impact this whole capital market. And I do think there's a difference, and we were talking about this at lunchtime, I think there's a difference between outcomes and impacts that we don't truly understand. And it's the impacts, I think, that link to the SDGs. 30 seconds over, I apologise. Thank you.
Thank you very much. Last. Okay.
It's probably.
It's okay. All right. Last but not least, it's Rhian Marie Thomas, who's the chair of Green Banking Council with Barclays.
Thanks ever so much, and thank you very much for inviting me to share a few words. There's always a risk when you go last that all your best points have already been made, which either means that we're validating each other with great insights, or you're just going to have to switch off for the next 5 minutes. But a lot of talk from my fellow panelists and this morning about the importance of data, transparency and disclosure to support the mobilization of capital. Obviously, we've touched on education, pressure from investors and disclosure, and I'm going to try and weave all of those into these remarks. Let me start by providing some of my own data. Earlier this year, Schroders, the British-based multinational asset manager, conducted a survey of 650 international asset managers, representing 24 trillion of assets under management, clearly a fraction of the assets under management signed up to the PRI, which I think is at about 82 trillion. Nathan, you correct me. But that made some pretty depressing reading, in that of those asset managers that responded, only 27% said that they felt that ESG considerations played any part in their strategic asset allocation decisions. 32%, a full third, went as far as to say it played little or no part at all in their decision-making. And so we question, what is that disconnect between good intention and action? Is it the result of weighted risk-return calculations being correctly applied? Well, no, because study after study, and this body of evidence is mounting, shows that companies or investments with solid ESG credentials have a tendency to outperform the market. An important point and a myth that keeps being repeated, that in order to pursue ESG investment, it requires some kind of reduction in yield. Barclays, back in 2016, provided a report on this, showing our own research that a bond portfolio with strong ESG attributes outperformed a comparable but low ESG basket. Recently, some work by SEB, the Scandinavian bank, showed that green bond issuers show lower ex-post default rates against an aggregate index, which is another interesting piece of data. A lot of talk about green bonds this morning, and rightly so. It has set the precedent and has elevated the dialogue. But let's not forget that only 14% of European non-financial institution corporate finance is provided by the bond and equity markets. The vast majority is from bank lending. And what are the incentives for banks to be lending to green and sustainable projects and corporates? Well, apart from the obvious ethical and moral arguments, the economic incentives for doing so are not very much. At the early stage technology end, the important, financing the solutions of the future, banks currently under the Basel rules have to account for 1,250% of capital against those investments. Those returns just do not work. Similarly, for the large infrastructure projects that we heard about this morning, those are long-term, highly capital-intensive investments, again, punitive from a returns perspective. So therein lies an opportunity for regulatory intervention. I'm not advocating that banks become incentivized to start taking early-stage equity risk, but certainly smarter blended finance solutions between the public and the private sector is possibly the way forward. And how about data against different green asset classes? We're starting to see, with the accumulation of more data, that certain asset classes present lower default rates if they're green. 2013 in the US, a study showed that more energy-efficient homes were less likely to default on their mortgage. Barclays have actually, in the UK, where we have a 10% share of the mortgage market in Britain, have actually replicated that, and those statistics have formed the basis of our green mortgage product. Similarly, a report by Moody's early this year showed that green project finance presents lower default rates. Lower default rates, lower risk, lower capital, lower pricing. That enables the green loan market to accelerate because it provides an incentive both for the banks to lend without eroding their P&L and for corporates to banks to borrow and for us to lend to corporates. And why is that not happening anyway? If those stats are out there, why do we need any regulatory or legislative intervention? Why isn't it moving more quickly? And I think my fellow panelists touched on this earlier, as did the Schroders survey data. But what we are dealing with here is cultural and organizational inertia, which is very, very difficult to shift. And the need for climate competent boards, the need for education right across the piece, the need for actionable and operable disclosure regimes such as the TCFD, which maybe we will come back to in a second, and full disclosure, I sit on that task force, which is devised by industry, by participants in the financial markets, and has now been signed up to by 522 multinationals who are putting the governance, the strategy, the metrics, and the scenarios in place. Thank you.
Thank you very much. I'm going to ask each of you to sort of respond to what each other have said. But I also think that, Fabian, when you were speaking about taxonomy, I think one of the issues I have is that many let's say, organizations or investors are called sustainable, whilst they might be investing in questionable assets, so nuclear weapons being one, that it's classified as sustainable. So I know taxonomy, as you say, will address this. So do we need to go beyond just the E in ESG? How can we actually help the investors to understand more as to something may be sustainable, but it still may be questionable as to what they're investing in? And I think just, Gianluca, in terms of what you said, it's all around performance data, and that is absolutely key, having performance targets. And, I was intrigued by your example of BP, because at the end of it, the asset managers were still investing and continue to invest in BP while they were clearly not adhering to what they should have been doing. And who's picked up the tab on that? The pensioners, really. So how can we avoid that kind of situation? And I think, Paul, from you, I take away that we need to integrate this much more. And how do we make this? Let's say, how can we make sustainability and in terms of financial information much more mainstream? When we are having the debate, and really that goes to you too, Rian, because one of the issues we're struggling with when we're having this debate, saying, well, you can't do it because there aren't enough assets and they will not be able to invest in this area. That's the kind of argument I get given, to say if I make it too difficult, the descriptions in the benchmark, there will be nothing there. But at the same time, if we make them really loose, then we've got the issue that we have continued greenwashing. So how would you suggest, as experts in this area, how we as policymakers should, on one hand set a tight framework, but also at the same time encourage more to go down this road so it becomes a much bigger pool of assets that you can invest in? So who'd like to go first? I don't mind. Rhian, do you want to go first? Yeah.
Sure. Just picking up on your final point about effectively the balance between flexibility and the risk of greenwashing. And I think today's debate is a good step in what I would propose, which is making sure that you have financial services at the table. And whatever we come up with needs to be operable. It needs to be something that we can interpret and that we can act. The work that the Commission is doing on benchmarks, I think, is absolutely key. 60% of UK equity investment is through passive indices. Therefore, what we will see over time, if we do this in the right way, we will see sector leaders, ESG sector leaders, as opposed to laggards, are going to start seeing their cost of equity, their cost of debt becoming beneficial. And that, almost in a way, is a de facto carbon tax coming through the financial services sector. And so I don't have the answer about how you manage to retain that flexibility whilst also making sure that you have a sufficient framework that can't be abused. But I certainly think one of the answers is to make sure that you have as many parties around the table as possible so that the people who will be implementing and using it get to have a voice early in the process.
If I can just follow on from that, I think there's another way of looking at that. I actually agree with everything you said, so I'm not going to follow it directly. But I think what we need to do is understand value. And I'm not sure we do. And actually, we're focused here, and in many audiences like this, we're focused on ESG, right? So we're tending to be focused on environmental and social. And the G is an extra. And actually, G is much broader than the environmental and social. And when you're thinking about value, from the integrated reporting side, there's the value in the talent in the organization. There's the value in the brand. If you take PepsiCo or Coca-Cola, where's their value? Predominantly, their value is in their brand. We don't value that. We don't have that up to the fore. And I think we need, when we talk about integration, we need to make sure that sustainability is not the only element that needs this integration. There's a broader understanding of value that needs to be had. And I would just say also around how do policymakers make this happen? Well, one route is through what I would call soft law, which is the corporate governance and stewardship codes. So corporate governance codes to companies, to boards rather, stewardship codes to investors, where you're actually saying to them, you must take these things into account. And if you don't, explain why you haven't, right? This comply or explain. And that will bring to light, and it may actually answer some of the questions around BP and other things, is were you aware of it as investors and boards, and why didn't you disclose it and explain it? And I think that's a key part that we lack in some of this discussion. We're always thinking about hard regulation.
May I make just a quick add-on point, which is, I'm in violent agreement, so sorry about that, no contention on this panel, but in order for me to do my job as a banker, I need to attest every year that I understand money laundering, that I understand sanctions policy, none of which actually impact my role very directly, given the products that I predominantly work with in the investment bank. Where is the attestation that I understand climate risk? And that those that are responsible for my organisation understand climate risk. And through the sort of softer regulatory requirements that we have in a regulated industry such as ours, that may be a way of pushing this through more quickly than waiting for the legislation.
Okay, how to avoid BP cases in the future? Well, following what the other panelists were saying, and specifically Paul, when he mentions the acronym and how, of course, the G is bigger than anything else because it's the overarching structure that makes things true, makes things happen. But what I've observed in 20 years is that we've been too much focused on mitigation. And still now, talking to my fellow friend here, Fabian, as someone called him, but his name is Nathan, they are concentrating also in mitigation because of lack of time, right? You're concentrating in mitigation and find out the taxonomy. So as the person from WWF this morning, Sébastien Godineau, I think is his name, he said we need also to identify the brown activities. Otherwise, we're focusing on a niche part of the overall economy. What's happening now across Europe, you're seeing disrupting events at global level. They're happening in the United States, in Europe, in Italy recently. And all these things can be faced only with great, massive action of adaptation, and we're not doing that. So who can do that? I believe the credit institutions have been rightly inserted in the compromise. They can do this because they transfer the reality of the economy from the people into the great infrastructure, into the meaningful things that the money should be directed to. So that's the first thing that I wanted to lean on. The other thing is about wording. I mean, across these 20 years, I've seen a lot of, mushrooming acronyms and stuff like SRI from SRI on. And the last thing that really hurts my tummy is non-financial declaration. Because today we think we are mature to speak about what's going on, but we still talk about things as non-financial. Take, for instance, a social problem like the attrition rate, which is the percentage through which in the company people go away and get replaced. That is evidently something that goes straight into the bottom line. This is something that touches the earnings of a company. Still, we talk about it as a non-financial item. So I think that we need to sit down and make the specialist analyst speak to the traditional analyst. And this is quite a simple exercise to make. You can make regionally, and you can make at events level. So when they speak, they can decide which significant indicators are important for each sector. We said before, BP, integrated oil company, that was a case of maintenance. But the first thing, and I heard the executive director of the Environment Agency this morning talking about stranded assets. Well, the first thing you ask to an integrated oil company is, tell me about how you account for your stranded assets. Is this an E, an S, or a G? None of this. It's just a way of calculating the reserves. Because when you buy an integrated oil company in the stock market, you are buying the reserves, that 1/3 of which is stranded. It's not be usable, but you pay fully for it. So the first question to do is, how do you account for this? If they answer, we don't know, like many do, well, that's a sign that they're not talking about their own sustainability in the future, because they're not trying to interpret the regulators and the legislator like correctly the Commission and the Parliament are trying to do.
Thank you. It's easy to miss the very ambitious approach at the heart of the taxonomy. I think for the first time globally, we're going to see a deliberate effort to bring environmental targets into financial regulation in a comprehensive way. This is a very, very important step. In addition, we're introducing a systemic element to this approach, whereby we've got a requirement to both make a substantial contribution to one environmental objective and do no significant harm to other environmental objectives. So this approach is different, it is transformational, and even though you'd expect me not to ask for extra work right now in the TEG, it is actually important to get this approach right, because if we get this approach right, there's quite a lot we can do with it. Now, I would say to you that if we land a very good environmentally sustainable activity list in a few months' time, or next year sometime, the obvious question becomes, well, what activities are not in that list and why? And then there will be a space for a conversation about how to advance the use of a taxonomy. And we'll be in much stronger territory because we can base that on a framework that's coherent. We will have opened up this question of environmental objectives in financial regulation. And we've heard today many times boards are struggling. They don't know what to do, which is why I don't quite agree with Paul. Value doesn't get you there because people don't know what's going to construe value in future. We need to do it on environment. Clearly, we need to do it on social. But I'll tell you what, that's going to take a bit more effort. Despite all our best intentions, okay? the work on metrics and thresholds and transformational ideas to bring into financial markets on social. We're going to need 2 or 3 TEGs on that. Whether we start now, whether we start next year, whether we start in 2 years' time, that's the matter for all of you. But we're heading in the right direction. We absolutely must have the level of ambition that's implied by the question, and so it's fully supported. I think it's a sequencing issue as much as anything. And for our part at TEG and for our part at PRI, we'll do our best to focus on getting very clear, coherent tools and frameworks that can be built upon over time.
Thank you. I'm afraid there's no more time, and I just want to say to the next panel, we were running late, but we've stuck to our slotted time, so we didn't overrun. So it just goes to say, can we thank all the panellists in the usual way? Thank you and well done. Lots of ideas, lots of food for thought that we can take forward. Thank you.
Thank you.
Hello, John Camp. Nice to meet you.
I know.
I will tell you. I will go down and tell you.
Oh, yes, thank you. Okay, this one. Okay.
So we are getting seated.
Yeah.
Well, good afternoon, everyone. Sorry for rushing through. You can hardly digest the previous panel, but that's life being at the last panel. And then I do get your point, Nina, that you had your slot. But of course, we still have a commissioner who is coming here at 2:45, and probably all the people need to more or less. At least I need to leave certainly at 3. So that means that I have to be very tough on my panelists, that they keep themselves to the 5 minutes, as of course all the speakers did until now, today. My name is Bas Eickhout. Happy to be here. I think we've seen some good discussions on sustainable finance in general. I am setting the scene indicators on the disclosure. And today or now it's being called, the right policy mix. So probably it's best to first give the floor to Martin Spoltz. Is that Spoltz, right? Spoltz. Yeah, I can't do it that nicely, but I just call him Martin. He's the head of unit of the Capital Market Union of DG Financial Stability, and certainly at the heart of the proposals that are out there. So I'm pretty sure that in 5 minutes you can tell why the Commission has struck the right policy mix balance, right?
Thank you, Bas. Good afternoon to all. I will try not to repeat what my bosses and the Vice President has already said. First of all, the action plan is not only about regulation. I mean, what we are trying to do, we are trying to set out a framework and the tools to the investors and also to the businesses, but we don't believe that we will reach that goal by throwing tons of new regulations only. I mean, obviously, we have also decided to intervene with a regulatory action, but we have also in our action plan proposed a number of actions where we expect a lot of progress to be done by the businesses and by the financial sector. It's a first step. We are obviously now also brainstorming about other actions that the next Commission can take. Whoever has some ideas, please pass them to me. We nevertheless believe that this is a very ambitious step already. This is not a baby step, and as we say in the introduction of the action plan, we really have the ambition to fundamentally change the way how the financial sector works. So now, just give me maybe 4 minutes now to take you through kind of five thoughts that I have. First of all, this project is not about the niche. This is not about regulating the green sector. This is not about regulating what is already green and leaving it green. We are really very serious about using and mobilizing the financial sector to help us and to help all of us to transition from where we are now to where we need to be. And here I'm not talking only about the climate challenges, but also environmental challenges and social challenges. And I guess that you have been already told that the Commission will present next week a very ambitious long-term strategy on how to reduce the carbon emissions by 2050. And this transition will be very challenging to do, but again, the financial sector will need to be mobilized. So also, as Nathan said, the taxonomy will not be only about the green activities that are already now, but will also identify activities that will help currently polluting sectors to transition to more greener. Second, we need to accelerate. I mean, there is a lot of hype in talks, and I am very happy for that, and I'm very happy to engage in debates, because this is also our job. But I mean, when I look at the assets that are actually invested in the sustainable space, it's still a very, very small fraction in the light of the challenges we face. So again, I would like to see much more progress on the side of the investors. I mean, our role, as I said, is to provide a framework, is to provide the right tools. Now, we will have those tools and these frameworks, so the ball is now also on the financial sector side. There are also laggards that need to be addressed. I think many of the panelists today, actually, they are those that are trying really hard to promote sustainable finance, but we also need to talk about how the financial sector can change the laggards in the system. And again, the engagement and stewardship are a very promising avenue. And there we don't necessarily have to, again, regulatory intervene, but again, promote the best practice and best codes of conduct. Third, we believe in doing this jointly. We cannot do this only in Brussels or from Brussels. We need that everybody plays its part. We have already had a very successful story and narrative with the high-level expert group. I would like to pay tribute to all the members of the high-level group. Now, I would like to thank all the members of the technical expert group who are doing an amazing job, Nathan and Ayla. Really, I'm very impressed. But again, the kind of the joint partnership by the public and private sector is something where the European Union has a competitive edge and where we really can get a buy-in from all relevant stakeholders. Fourth point, I'm slow, sorry, global outreach. What we need to do, we should not only get it right in Europe, but we should also try to avoid fragmentation at the global level. There are some jurisdictions that are very willing to do more. So it's very important that the EU not only does the job and leads the ambition on promoting sustainable finance, but also talks to other jurisdictions and tries to exchange experience and promote the best examples. Finally, this is not only about challenges, this is also about great opportunities. And great opportunities not only for the financial sector, but also for the businesses. So ultimately with this project, we really truly believe that if we make it right, we can ultimately make Europe and European capital markets as the hub for sustainable investment from elsewhere, and ultimately inspire other jurisdictions to adopt similar policies. We believe that by this action plan and by the proper implementation of the action plan and by everybody playing its part, we can ultimately enhance competitiveness of the European economy. Thank you very much.
Perfect, Martin. Timing, I would say. No, thanks a lot for your additional points. I think there are probably quite some points that other panelists will react to. But first, I give the floor to Joanna Kund, right? Count. Oh, sorry.
Pound.
Sorry, or maybe, no, yeah, I was about to say, you should go first now. Sorry, that's my mix-up, because you have to leave early, right? So, in that sense, I give the floor to you first now, quickly. Sorry for my mix-up.
Thank you very much, and maybe we can do that.
Oh, you do it for yourself?
Yeah.
That's
great. So, and I'm Flavia Micilotta for Eurosif, working for Eurosif. Eurosif is the European Association for the Promotion of Sustainable and Responsible Investing in Europe. And indeed, I'm a proud member of the high-level expert group that indeed helped the Commission in setting up the first step towards the achievement of the action plan first, and now getting into the work of the TEG, which is going to make sure that the steps become more concrete and that finally we'll be able to grab the fruit of our hard labor, I would say, from the legislative perspective, but also from the practical financial tools which are highly needed from investors everywhere. And indeed, being part of the high-level expert group, I remember that still one of the major discussions that we had were around, of course, defining sustainability, and that's how we came up with the importance to work on a taxonomy, which is indeed one of the most important chapters that we've discussed a little bit already today, and which indeed lies at the basis of any sustainable finance strategy going forward. Achieving a good taxonomy will indeed help greatly inform investors on how to direct their investments, while at the same time laying the foundation for standards and labels around financial products, which I think is absolutely essential and key. One of the other main elements that I think we worked on and that you picked up nicely in the action plan is indeed, well, around the concept of fiduciary duty, so clarifying the concept of fiduciary duty and embedding the knowledge of ESG and sustainability into fiduciary duty, which is indeed one of the main concepts that my organization really lobbied for a long time. So in a way, it's our dream come true. And indeed, investors' duties and disclosure chapter remains the most symbolic part of the sustainable finance change and foresees disclosure obligations on the way institutional investors integrate ESG criteria in the risk process. Being much in line with Article 173 in France on a European scale, the Commission will help to look at specifically setting disclosure parameters for asset managers and investors to disclose how they concretely apply the concept of fiduciary duty by sharing the work in relation to the impacts achieved. Now, we heard several speakers talk about the importance of transparency, financial education, also impact, of course, and impact investing is one of the most important, most fast-growing SRI strategies. It is even today. As you might be aware, my organization actually publishes every 2 years a study, which is the sole one tracking the SRI flows across Europe. So we track how different SRI strategies have evolved across different European countries. And indeed, we have noticed that impact investing has really become the newest kid on the block, the fastest growing strategy, and that really signifies a strong appetite for any kind of institutional or even retail investors to be able to make a difference with their investments, and they choose sustainability. And so what is really clear is that they must be given a choice, they must be given a voice. That goes hand in hand with financial education, but also at the same time the huge challenge of helping them understand what sustainable finance is all about. That's why I think that in all the plans of the Commission, starting with the taxonomy and the other chapters, makes absolutely a lot of sense. Today, European household savings represent over 40% of the total financial assets in the EU. And there is growing evidence, as I said, in different parts of Europe, that most retail investors would like to invest in a sustainable way. Once again, with the Eurosif study, we track how retail versus institutional investors have grown in demanding SRI. And the good news is that in 2014, the figure for retail investors demanding SRI was just 3.4. Today, well, we'll unveil all the figures, all the findings of our study next Monday, but I can already give you this bit of information. We grew to 30%. That's huge. That's absolutely huge. And that signifies that we need to really move fast in order to capitalize on this interest and be able to further add to the wave of sustainable finance. Today, there are indeed a lot of labels for SRI products. I think it's very good, but I also think that it can indeed create some confusion for investors, specifically retail investors. I think that going forward, one of the things that are needed, and I think it's already captured substantially in the work of the high-level expert group in the final report, but it's really helping better to define what an SRI investment is. I was very happy to hear the main speaker this afternoon, the keynote speaker this afternoon, actually saying that going forward, all SRI all investments should be by default SRI. That would be great, but we need to start somewhere, and we need to define what are common benchmarks for those SRI investments? What are the clear denominators that can allow clarity and transparency for investors? Thank you.
And apologies, but Flavia has to leave, I think now,
yes,
right? So,
thank you.
apologies for that, and that's why I also got mixed up with the order of the presentation. So, because Joanna Count will come now. You're from BlackRock and Head of Government Relations and Public Policy, so also interested to hear your 50 cents on this issue.
Thank you very much, and thank you for inviting me to participate today. The key messages I'd like to convey are we're very supportive of growing sustainable finance, and Europe has a real opportunity to take a lead here. The single most important thing in viewing the policy mix is to view it through the lens of the end investor, the retail saver, the pensioner, the insurance company, as it's they who decide whether to invest in the markets, what to invest in, and how to invest. And that means they need to understand the value proposition. And for those reasons, we would, out of the different instruments, we would prioritize the taxonomy and meaningful transparency. The second thing I'd like to stress is that to mobilize more capital towards sustainable investments and make finance more sustainable, we need to safeguard the existing alignment between asset managers and asset owners. If asset managers are required to do things that their end clients don't want, it'll only be counterproductive. They'll take their money and put it somewhere else, not what we want. I want to say a couple of things about how BlackRock approaches sustainability. The most important is that we truly believe that the environment and social and government factors impact investment performance, and therefore we're spending a lot of time incorporating sustainability across our entire platform. In doing so, we distinguish between values on the one hand and value on the other hand. So what do we mean by values? A growing number of our clients are saying that they want to achieve certain goals, either as individuals or as organization. And therefore, we need to be able to provide them with the solutions that to meet these goals. And that might be avoiding investing in certain companies or asset classes, or it might be achieving some positive outcomes in terms of pure ESG performance, thematic goals such as low carbon investing or impact investing. I think Stan mentioned impact investing at the beginning. I should say this isn't new. I looked up our first fund that we launched on sustainability was 2005. So it's a question of offering more and more and more. However, we also have investment value. And that is, actually, I should have said, out of the 500 billion AUM that we manage to date, our clients, when they're expressing their values, they're going for the strip out certain nasties rather than invest in the positives. So 450 out of the 500 is on the stripping out side. In terms of investment value, that's where we can take an investment decision that incorporates ESG into our classic investment process, and we do this because that performs better over the long term. So that requires an investment in data, technology, people and processes to embed sustainability throughout the platform. Data, that's our own research, that we're taking external research, doing our own research, and trying to make it digestible and usable for the fund managers so they can actually do something with it. In terms of the people and processes, ESG has to be owned by the separate investment teams, and the challenges of ESG are hugely different whether you're talking about private real estate or equity investment or even short-term fixed income investing. So it has to be led by reputable fund managers within those teams that others want to follow, and they develop processes and analytics that are relevant for those teams. That's all on the active investment side. You also have index investing, and there we cannot choose what companies we want to invest in. The client chooses the index, and then we have to invest in all those companies in that index. So what can we do? Well, we can provide the solutions I mentioned to earlier, but we also have investor stewardship. The whole point of investor stewardship is to engage with companies to produce more sustainable economic returns for our clients, depend on these returns for their pensions over the long term. ESG is a core part of that. I would agree with what people said earlier. If a company is good on G, if good on the governance, it's normally good on E and S, but we engage across the board on all of those factors. I should say there's a feedback loop. Somebody mentioned some companies where, how come you didn't know? Or well, you do get to know, because if you're doing investor stewardship, there's a feedback loop to the fund management teams, and they can adopt their approach accordingly. So on some of the companies that involved, we had reduced significantly exposure. So it does work. Moving on to the regulatory framework, I'm going to have to speed up a bit. In terms of attracting capital, one thing that we should always remember that often we have much more demand than we actually have supply. So that's where InvestEU comes in, right, importantly. It's also where getting from the end investor perspective, securities regulation, prudential regulation and tax right. LTIF is wonderful. It could be really good in terms of attracting money in this area, but clients face double taxation. So that's what I mean by putting the end investor in the center. Everything has to line up, because otherwise you're not going to attract it. I would re-echo what people have said in terms of transparency on the corporate side in particular, but turning to the proposals, we think they strike a relatively good balance. We very much like the disclosure proposals, because we think that's the right approach to the Commission's proposals, or the right approach to greenwashing. It gives the end investor more information to make a better decision. It allows choice, diversity of solutions, and it puts the onus on the product. It creates a race to the top, putting the onus on the product provider to get better. We're also favourable on taxonomy, a couple of issues there, but we can come on later, and the EU-wide product label. Areas where we're more cautious, anywhere where you're not getting an alignment between the different actors along the investment chain. I can come onto that later. And also we're cautious on sustainability on the retail side. It's a pity the lady's just left. We do a huge amount on incorporating on the institutional side. We can ask surveys, but it's actually, unless you're doing index, and there's more than index in this world, it's challenging to take a retail client says, I want sustainability. You have to then build that in with the time frame, the risk, and the cost, because sustainability is often more costly, and it's not necessarily always the right outcome for the end client. The final word is take inspiration from UCITS. Why UCITS is a success, and apply that to sustainability. And I can say more on that later if we've got time.
Thank you. Thank you very much. Indeed, probably time is going to be a bit of the restricted side. So, and I would like to give the floor to Ayla Ho. You're the executive advisor on sustainability with Nordea, and you are on the tag. So, probably also good informed to give us the latest updates, probably.
A lot has been said, and thank you for giving me the last word now, almost at least. What I would like to emphasize is that the first step of sustainability is really mainstreaming transparency. So without adequate transparency, we can't get anywhere with the sustainability and its implementation. So the proposals that we have on the table on increased disclosure are really, really positive for that. Then about ESG, we have also done research in Nordea that shows that well-rated in terms of ESG companies have a better performance in terms of returns, but also in less volatility. And that goes for equity and bonds. So there is evidence that it is a good tool to use in investment to enhance returns, but also to mitigate risks. However, it does not answer the question that we at least get quite often, both from investors and issuers, that what is green? You can't expect the professionals in the finance industry. We have been going to the economic education, finance education, lawyers, We have no clue how the nature works, and do not ask us to define what is green. We do need the policy to fix that. And it is actually a real issue, and it goes also for corporates. So I do welcome this taxonomy proposal that will give us some kind of framework that we can start to educate our people, because this is a huge education process. We need to build processes, we need to build the ability of our people to talk about sustainability, what is environmentally positive, with our clients, our risk managers to understand what this means in terms of risks. And remember, they don't have the education, and some have interest, but quite many, even those who would like to do it, consistently ask me, how can I integrate this into my daily work? And that is what we are talking about here now. So the green bonds actually started with bringing the transparency into the finance, and I would call it a true novelty in this industry. You can see a picture there, which is of our green bond. What impact on environment does 1 million investment in that bond bring? So it's a certain reduction per tons of CO2, amount of clean water, and things like that. Not a normal standard reporting in financial reports, but this is how it needs to look like to make relevance for the real economy. And this is also an opportunity for the finance industry to get us a little bit closer to the real economy and to make what we do understandable. But you cannot imagine, I think, how much details goes into that small picture. In defining how to measure this carbon, how to take it out of the hundreds of loans that are behind those 500 billion. So it's a big investment. So we need frameworks that are simple, comparable, comprehensive, and people get. And this is how it looks like. It's much prettier than a table with numbers, I think, at least. So then coming to this taxonomy and the work we are doing in tech, I think it makes perfect sense to start with climate. We have enough data about that. There's no question about the relevance. There's no question about the need for urgency there. And if we start somewhere, we have something tangible to start developing our processes and educating our people, as I already said. And more importantly, I think we haven't so far talked so much about the bank's role here, and particularly the corporate's role. The financing or sustainable financing is not a substitute for real economy measures, for example, like pricing of the externalities. Those are also needed. So finance will not fix that. That you will have to fix. I hope you will do it. But we will try to do our part. So answering all the problems, finance will not do that, but hopefully it can do a fair share. So these are not substitutes, both are needed. I think that the taxonomy is an opportunity also for the corporates to have something to look for. What does a future-proof business model look like in my industry? What does a low-carbon economy look like in 2030, 2050? There's a true confusion among the corporates at the moment that if I think that this is sustainable, do the investors share my view? Am I going to be shamed in the market because I'm trying to greenwash? Simply because I don't know what would be deemed green. And I hope and I'm fully confident that taxonomy will get us over this hurdle. It won't be perfect, but perfect is often the enemy of good. So let's not let this idea of being perfect to stop us starting. I think we need to stop now, and we need the investments. So let's start with education. Let's get this going. It took decades to do IFRS. Let's start now with this one. Thank you.
Thank you.
It's a bit sobering that you say that the finances will not solve it all. That's probably quite some politicians were hoping that they now could lean back, but that's probably, well, I think we know it's not. Really, my sincere apologies that we were rushing a bit through this panel, and I think there's a lot of issues that are being mentioned about acceleration, about the education, about how to keep the asset managers and asset owners in line. But we can't discuss. That's really apologies for that, because that's just also, we have a commissioner in the room who also has a busy schedule, so he needs to come forward. So I have to conclude the panel here. So my sincere apologies for that. Thank you very much for that. And we all know that this will be an ongoing discussion. And I can tell you that Sirpa and I, we will publish our report as a parliamentary action on the taxonomy at least. I'm pretty sure that that will also be another start for further discussion on the issues. And let's hope that we as a parliament at least can get to a quick position then as well. Because we do know that meanwhile the world is advancing and quite often faster than the politicians can keep track of. So thanks a lot for that, and also good luck with your work in the TAG. And I would like to give a round of applause. Thank you very much. And I think I would like to ask Sirpa to come over here and the Commissioner to come over here. Yeah, it's in my playbook that you have to come over here, Sirpa. Yeah, you look surprised, but it says Sirpa to take the seat next to him. That's you. And you are even planned to introduce the Commissioner. So I'm pretty sure you can do that on the fly.
Okay. First of all, thank you for everybody for very constructive comments and discussions. Indeed, I will join Bas on regretting we did not have time to discuss on these times, but we'll ensure that there's going to be the next time, because this is not the end of the story. It is quite contrary, just the beginning of it. And we are very happy to have two commissioners committed on sustainable finance, and I know that there are quite a number of others as well. But Jyrki Katainen had an opening keynote address, and now we have the privilege of having our environmental commissioner, Carmen Novella, to have the closing address. And you have worked, of course, for circular economy. That is extremely important part. There's the circular economy monitoring platform on the go that is linked with the indicators, and a lot of things going on. So we are very happy to have you. And now the next steps and the future from your perspective. Please feel welcomed, and the floor is yours.
Thank you very much, Sirpa, and thank you, Bas. And they told me there was a very good lineup of speakers already. And that's very good. And I think I have to thank you both for asking me to close this conference. It's always a pleasure to join these Globe events, because they feel like an opportunity to step out of a process and to have the opportunity to look at the bigger picture. And that big picture is particularly important with an issue like sustainable finance. So much, as I'm sure has already been said, depends on having a very solid financial platform for the future. In fact, I have just come back from Sharm el-Sheikh. I came from Egypt for the biannual UN gathering on the Convention on the CBD, the COP14. And the take-home message was both familiar and also very, very clear. We need an urgent transformation across all policy fronts and a rethink in how we attribute value at all levels of our decision-making processes. With an increase in consumption of natural resources by about 190%, almost 200% over the past 50 years alone, the Sustainable Finance Package represents the inception of this invaluable shift in approach, an approach that has the potential to finally start to alter our perception of risk, what risk is all about. This is no small feat, how policymakers and businesses perceive risks is far from inconsequential. It has the power to affect the macroeconomic judgment of countries, of sectors, and also of financial markets. As with every challenge, also comes an opportunity. And I am proud that the Juncker Commission has been at the very forefront of seizing this first-mover advantage for Europe. In a rapidly changing global market, developing a competitive advantage for EU financial services takes innovation, and it also takes a bold stride forward. Doing so, however, presents our best chance for hedging against threats to financial stability. Hedging, in particular, against the threats we know will emerge from the growing pressures on climate and the environment. We talk a lot about sustainability, and sustainability isn't just about weather-proofing our financial decisions. It's also about having the right judgment call to avoid bad choices in the first place. Smarter financial regulation should deter certain investments. It needs to stop decisions that could end up making a devastating contribution to climate and to the environmental degradation. Decisions which, in the absence of our initiative, will continue to drive a collective race towards the bottom. Does it make sense, for example, for banks and investment funds to sponsor poor agricultural practices that are primarily responsible for water scarcity, eutrophication, and pollinator decline? Isn't that precisely the sort of investment that we ought to discourage? My hope is that sustainable finance should redress that balance. I wanted to move us away from the short-term thinking of the past and to factor in more elements that have a tangible effect on our future. And that is what makes this package so remarkable. It has the potential to be a massively positive force directing investment to places where returns go well beyond short-sighted profits. For the first time, honourable members and colleagues, we have an initiative that integrates a much broader appreciation of profits and value, a more honest appreciation which is clearly in the interest of Europe. But let's start by recapping on why we need this. Recent years have given us a much better appreciation of these downsides of our current economic model. In a number of areas, public opinion is turning. What economists once called negative externalities are now considered for what they really are. These externalities are actually causing serious problems with the air we breathe, with the water in our rivers and in our seas, and consequently with our own health. Problems with our climate, with pollution, with plastics in the ocean, all of which result from an economic model that tried to ignore the effects on the environment. Citizens, governments, and the businesses and financial worlds are thankfully waking up to the reality of the value of investing in environmental protection. The World Economic Forum has shown the way. In its Global Risks Report, environmental issues are very high on the priority list. And in their 2018 report, 8 out of the top 10 most impactful global risks are either directly environmental or somehow linked to environmental degradation. And here the message is very clear. If we don't address these risks, we threaten the stability of financial markets. Politico recently featured an article about Mark Carney, the governor of the Bank of England. Not the first place you would look for an eco-warrior, but that's how they describe him, praising his efforts to force banking and insurance to start taking climate change into account when managing risks. Similar messages were recently heard at the G7 in Canada. In Halifax, Canada, the links between a healthy planet and sustainable economic growth were discussed, with a specific focus on taking urgent action on climate change, encouraging sustainable finance, conserving nature, and advancing a resource-efficient economy. If you look at the Chair's summary of that G7 meeting of environmental ministers, the word that leaps off the page is opportunity. As they were at pains to stress, this isn't just about risks. It's all about potential gains. And the more daring we are, the greater are those opportunities. That's the approach we need here in the EU. And we can do it through the SDGs. Turning the SDGs into a transformative EU agenda is an opportunity, is a chance to modernize our economies, a chance to steer finance towards new sources of sustainable jobs, new sources of sustainable economic growth. The transition to a low-carbon, resource-efficient and circular economy offers significant opportunities. The changes are already happening all around the globe, which means that Europe will have to work harder to stay ahead of the game. Other regions are moving fast, so as policymakers, we carry a responsibility to push, to help Europe to innovate and to maintain its leadership. This brings us back to the action plan on sustainable finance that we adopted in March, and also the legislative measures that followed in May, which were, I take it, discussed today. As you have heard, implementation is moving at speed. Europe is still leading, and the world is still watching. There has never been a better time to put this plan into action. HDFC Securities, one of the top Indian investment banks, recently calculated that $13 trillion currently sit in bank accounts with negative net return. Capital should not remain idle. Sustainable finance is an opportunity to put those funds to work through investments in sustainable projects, a chance to leave carbon behind and to mobilize these massive sums for investments in renewables and in nature-based projects. And speaking of working with nature, I should also mention another complementary track, that is the sustainable blue economy. A few weeks ago, at the Our Ocean Conference in Bali, together with WWF, together with the World Resource Institute, the European Investment Bank, and the UN Environment Agency, we took a major step forward, announcing the first world's initiative to finance a sustainable ocean economy. The idea is that every new investment should be aware of its impact on the ocean, and that once the awareness is there, environmentally and socially sustainable outcomes will have to follow. It's the best road to keeping oceans healthy and keeping oceans productive and also attracting sustainable flows. An IT tool is being developed to help investment management assess the sustainability of investment decisions, showing how profitability can go hand in hand with environmental and social stewardship. And this, of course, will also help us reach SDG 14, conserving and sustainably using oceans, seas, and marine resources. All in all, I think this is a very huge step forward. To complement our drive even further, over the coming months, the Commission will be putting forward new guidance to support decision makers at all levels integrate ecosystem services into their decision making. Dear colleagues, it's time to wrap up the day, and I think we can summarize as follows. We have a vision of where we want to go. We want to deliver on the Sustainable Development Goals. We understand the scale of the challenge. There is an urgent need for more investment in the Paris Agreement and in waste, in water, in biodiversity, and in air. We agree on the need for a coordinated approach because getting to a greener, more sustainable economy, including a sustainable blue economy, is a huge challenge that requires action on multiple fronts. And to make it happen, we need to convince partners that this challenge comes with a massive opportunity, an opportunity for financial intermediaries, institutional and retail investors, an opportunity that policymakers need to encourage. Environmental protection in the EU is a prime example of leadership for the benefit of all, for citizens and businesses alike. The environmental legislation that we have put in place since the 1970s amounts to the most comprehensive modern set of standards in the world. It's helped improve the environment, it reduced pollution of our air, water, and our soil, and it has stimulated innovation and investments in environmental goods and services, generating jobs and business opportunities. The IRP, the International Resource Panel, recently calculated that 60% of the built environment that will house the world's urban population by 2050 has not yet been built. That is, quite frankly, the biggest building opportunity in history, an unparalleled opportunity for sustainability. So let's make certain that we get it right, with the right financial architecture for the citizens of tomorrow. Thank you, and thank you, Sirpa, and congratulations for this event. Thank you very much.
So once again, thank you for your commitment and support for this work, Commissioner Carmen Vella. And I would like to thank all of the participants once again and invite you to be part of the discussion and network. There's this kind of an informal platform of sustainable finance on the way of building, I know. And so if you feel an interest to be part of that debate, with your permission, information of that is delivered to you, and please feel free to sort of connect on that network, and so we have a inline and maybe once in a while physical possibility to continue these discussions. Thank you and have a nice day.